Okay, we are back. So Jean-Luc you're now, yep, screen sharing. So we're going to first kind of just walk through the platform and learn how it all works. So for privacy mode, you're going to want to go to up at the top where it's like either net liquidity or day trades or option buying power, either of those things, and just click on that up in the account info bar.
There we go.
Yep. And click on that and activate privacy mode.
All right.
All right, so privacy mode, you can see it covers your account number. Also up at the top there in the center.
Yep.
It covers that, and also your dollar. So it just kind of is like, gives you, if we're streaming, especially if it's a real account, good to have that to be covered for anything that could be shown publicly or whatever. All right, so we first talked about manipulating the chart using the pan tool versus the arrow tool or cursor, whatever they call it.
Mm-hmm.
Let's we can play with drawing tools, or we can play with there's some other things. What do they call it? There's pan, and what's the other one called?
There's trend line and pointer.
Pointer. Okay. Pan and pointer. Got it. All right. We can talk about setting up the charts as well. So you see up at the top right, there is a rectangle. Yep. So set that so, for example, it shows like 4 squares, like highlighted. You'll see what that does. So with that, you can see how there's like the next to each thing where it says enter symbol, there's like a chain link next to enter symbol.
Yep.
So for that, for example, we could have that linked to a separate watch list if we wanted to, or anything else really. So the watch list thing where we have it set to the red one. That's how you can synchronize different charts to different things, basically.
Gotcha.
So you can control like what comes up where.
So this is the red watch list. If we wanted another watch list watching a bunch of separate companies or other stocks, then we could have one running concurrent over here.
Yeah, and we can have 2 charts, and that box thing lets us set them up like you can do one over the other. You can do one side by side. So that's the side by side. Yeah, it just lets you, if you want to view multiple things in at the same time, you can do that. But generally, one is the way to go. That's all you really need.
Gotcha.
We can also look at one thing I'll tell you about this platform is that it's so like it's got so much depth to it. Like, I'm every now and then I still learn something new that I didn't know. It's really incredibly powerful. We can go to let me think of something else that's fun. If you do want to look at like the fundamentals of a company, you can go to like, let's look at analyze.
Mm-hmm.
And then, okay, by default, it goes to fundamentals. Let's put in on where it says enter symbol, put in AAPL. And hit enter. Yep. So this is something where we can take a look at, it has ratings from different analysis groups, Market Edge, Morningstar. Morningstar is usually pretty good. Schwab equity ratings. These are just some internal things. And then we can scroll down and we can see like news, anticipated things. You can scroll down more. We'll get to see the keep going. We should be able to see things like the market share you can see a lot of data about companies. You can read about them. And then if we go back up, we'll be able to see the up at the top. We can see things like the what is it? Where would it be? Can you hit the company details thing? Click on that, maybe.
It popped up a chart. I'm not sure if it's casting it. Do you see it?
Oh, yeah. No, I don't. But don't worry about that. That's fine.
It popped up
We can do a different one. Put in say, put in GE. Let's see what they're looking like.
I think they're not looking that good, as from what I can tell. They had a stock high and they were covering. They're on an uptrend, but I look at it sometimes 'cause my dad has GE stock.
All right. So this is a way that we can look at a lot of the fundamental data, and it'll just give us some kind of basic info. Let's just go to the chart.
Oh, back to monitor.
Yeah, to charts. Right there. Yep. And put in. Yeah, we can also look at. Let's just do GE. It'll have the same sort of stuff. All right. Wow, that was a big dip that day. Let's zoom in on that day. Actually, this would be a good example of talking about price action. So that was when they had their earnings. So we can see that there was a lot of after hours. There was a lot of.
What does after hours mean? Like, how can you trade after hours? I thought the market would be. Isn't the market over?
No,
Like for the day?
no. The spreads get much wider. So here we can actually see the spread right now. Like right now, it's still trading, but it's post-market trading. So there's the main characteristics of post-market are that there is dramatically reduced liquidity. So instead of having, well, you can actually see the volume graph at the bottom. See, the gray areas on the chart represent after hours trading, and the black is during the day.
Okay.
And we can see that during the day, during the black, if we look at the volume, it shows like a lot of points during the day. It was hitting 1 million shares in volume.
Of being traded?
Yeah, see, like if you look at the blue graph at the bottom of your chart, where it has the blue lines.
Yep.
And then it says on the y-axis, it says like there's like in the middle there's a 1, and it says millions next to it.
Yeah.
That means millions of shares. So we can see there are plenty of points during the day where it was at, somewhere between like 500,000 and 1 million shares trading. And then during the overnight, the after hours in the gray areas, you can see that there wasn't even enough volume to like register on the graph.
Oh, that's 2 million. Is that open of business right there?
That's
1.2
no,
million?
that's just over 1 million. Yeah, 1.2. Yeah, correct.
Is that overnight or is that?
That's during that hour. That means 1.2 million shares traded in that hour.
That's at
during
9 a.m.
That one candle.
Dang.
But if you put the mouse put it on like in the middle of like between Wednesday and Thursday in the after hours, like just like 3 candles left of where, or yeah, that's fine too. We can see volume was what, 100. Go a little, another candle left. 248 shares.
Yeah.
So like nothing. After hours trading is very interesting. It's a little bit tricky. It's not really useful for people like us because after hours is great if you're an institution because there's very, very little before where, like in this case, at the bid and the ask, when we're talking about limit orders, you might have a couple of million people on each side, a couple of million buyers up against a wall of a couple million sellers. So if you're a big institution, during the day, it's a great time to accumulate positions. But it's not a good time to move the stock because it would just be so capital intensive to actually get movement to happen. Whereas after hours, there's way less liquidity, way less volume. So you can't really get positions of any great size filled, but you can move things around. You can push price up or down after hours with relatively little money.
Okay.
So if we look at those, and in the space between, go to the gear at the top.
Gotcha.
And let's turn off, go to equities. And then go to show extended hours trading session and turn that off. All right, and okay. And now let's zoom back in on the same area we were just looking at. So the way that it will appear is as gaps in the chart. So the way that you can really think about a gap in some sense is like a big candle. That was an earnings announcement right there. You can see the $1.03. That number means that GE paid out a dividend of $1.03 per share to their shareholders.
Okay.
And dividends are generally released on the same day as earnings announcements.
So that came out at the open of business. The dividends.
The earnings announcement came out before the market opened.
Okay. Then when the market opened, I just don't know why were people like waiting for their dividend to hit before they sold their share or something? Is that why?
No, in this case, I'm guessing that they had a good earnings announcement. And someone pushed it down after hours so they could buy it on the open.
Okay.
We'll go into stop sweeping in another time. But those things will appear as gaps. And if you go to SPX, you're going to see the same thing, where there's these gaps between opens and closes, or closes and opens, I should say. Just blank, empty space. Like if we look right there, yeah, right there. That's a big gap. Or you can use the other tool to like zoom in on that month more easily.
Which month? Ours?
Double click to zoom out, like that one where there's that big huge gap up.
Right here.
That's one. I was thinking about the one that's back in. Can you double click again? I want to see the month. 11.9. Use the other tool, not the pan, the pointer, and just drag from like 11.1 to like 12.1. Yeah, just click anywhere on the chart from like there. Just click and drag to like 11.1 to 12.1 across the chart. Yeah, to select that area. Yep. So there you can see that's a huge gap. So that was where the market went up was pushed up in the after hours trading, then opened higher. Okay.
So I get that this is a visual representation, but what are the units on the right?
That's S&P price.
And so, I don't know. I'm thinking in dollars. I don't.
Yeah, it's basically, just think of it as dollars, as the share price, essentially. The S&P is an index, S&P 500,
Okay.
which is not 500 symbols. It's actually 505. Because of some companies having A stock and B stock.
Mm-hmm.
Like Google has GOOG, and GOOGL, where I forget which one, but one of them is common stock and the other is preferred stock. And basically what that means is one of them is voting stock and the other is non-voting stock.
What is SPX?
SPX is just the index, the S&P 500 index.
Okay.
And you can see how that's weighted. Go to Market Watch and go to heat map, visualize, and then go to indices. Hit the down arrow on indices, and then hit S&P 500. So here, these are like each square is the size of the square is proportional to how much of the S&P 500 these companies are. Like if this this big huge rectangle with all of these smaller rectangles and squares in it, you know, if the big rectangle is the whole S&P, then the size of each square is basically just a very visual representation of how large those companies are as a part of the S&P, like what percentage they are in effect. If you go to visualization and where it says heat map, I think there may be other ways to view it. Up there, it says visualization. Right now it's selected to heat map. Top left, yeah. Does it give us index watch? What does that do? Oh, no, never mind. I thought there was a way to do it as a, just go back to heat map. Thought there was a way to display it as a, like a pie chart, something like that. Some platforms have that. Anyway, but here we can see all the different companies and also how bright or dark the green or red is representative of how much that company changed today during trading today.
Like Apple looks like it's, what does the dark red mean?
Dark red, like if the closer it is to like gray, that means very little change. So if you move the mouse over Apple, that the little box that pops up will say percentage change 0.017%. Negative. That's why it's just barely red. If we go to IBM, that went up 9.5% today. So that's why it's really bright green. You go to Tesla, that's probably going to be down 7%. Oh, 12%. Wow. Okay, so Tesla had a rough day.
What's this? Humana.
That's a health insurance company.
They took a killing.
But yeah, like see, it's also divided up. So like you can see right now you're moving the mouse around in the healthcare sector.
This is the financials.
Yep.
It's interesting to visualize these parts of the market because everyone talks about the market share, but I've never seen this before. I didn't realize like Nvidia was that big.
Oh, Nvidia is huge. Nvidia is worth $1.5 trillion.
I've never heard of IBM. Well, I've heard of them. I don't know what they do.
Yeah, no one knows what they do anymore. They used to like be the king of computers, and now I don't know what they do.
Johnson.
You got Amazon is big, obviously. That's what, $1.6 trillion market cap.
Yeah.
So the market cap, that's another term. Do you know what market cap means?
How much your stock can be worth at a maximum?
No. So market cap is basically, it is the price of the stock multiplied by the total number of shares. So if we had a stock that was $10 and there were 100 shares outstanding, what would the market cap of that company be?
1,000.
Exactly. The company would be worth $1,000. So basically, you multiply the price of the stock by the number of shares. That's how you calculate the valuation, or in this, the technical term is market capitalization of a stock. So when you see like on Microsoft here, it calculates it in millions. So it says basically 3 million, which is a goofy way of saying $3 trillion.
Okay.
So that means that's the total value of all Microsoft stock put together.
Dang.
Now you can see on the bottom left, Google, there's two Googles.
Is there Alphabet? And no, there's Alphabet A and C.
Yeah, so the A stock, that's the preferred stock. That means that if you own Google, that for every share, you get one vote on any issue that's a shareholder vote issue.
This is the stock that they give to their employees when they tell them that they get paid in stock.
Some of it is. That's the common stock, though. That means basically everything about it is pretty much the same, except it's non-voting. Google also has a Class B stock, but that's not traded publicly. That's held privately by the founders.
Gotcha.
Like it's the same with like BRKB in the financials. That's Berkshire Hathaway.
Yep.
Yeah. That's the B class Berkshire Hathaway stock. And it's a market cap of almost $1 trillion.
You know, people talk about Mark Zuckerberg being really rich, and that is a lot, but his market share is like a lot smaller than Microsoft, Google's, and Apple. Yeah. But Tesla's tiny too. But
Tesla was over $1 trillion. They've had kind of a rough year.
Where is SpaceX different from Tesla?
SpaceX is not publicly traded.
Okay.
You can buy it. There are actually private equity firms selling Tesla stock, but it's private placement, and the minimum block is $50,000 at a time. So now, if SpaceX does an IPO or initial public offering, then they would probably appear on here. But SPX is basically just it's one price that is derived from the cumulative value and price changes of all of these companies put together. So that number that we see over on the watch list, the last price, the 48.94. Basically, what that means is that's a number representative of these companies' cumulative performance together.
Where?
Like on the watch list or on the chart, like it says 48.94 next to SPX on our watch list.
Yep.
Yep. That's basically just a representation of a price that is reflected by these companies put together. So let's see what else. If you go to all watch lists, that's actually kind of wild. You can see like everything, or go to indices. Click on all indices. I think it duplicates because it has S&P 500. But if you go to all watch lists, you can see how many things there actually are.
Jeez. Why
Pretty wild.
It's duplicating though.
Some of them are duplicated, yeah, but it is like you can see. It's an interesting way of reflecting it. So yeah, those are like the Dow. Those are different indices. Let's see, ETFs. So over there, you can see we have. I'll show you something else. So BRKB, Berkshire B class. That is the common, and Berkshire B has been split. Do you know what that means?
No. Does that mean that they divided their stock price in two? So people who had one share have two now, and they just lowered the price of their stock.
Yeah. So, or it can be a 2-to-1 split. It can be a 5-to-1 split. It can be a 10-to-1 split. There's really no limit on how many times you can split it. But if you type in, if you go to charts and type in BRK/A, you can see what would happen if a stock were never split. Look at the price. That's
That
per share.
Is that $574,388?
Well, you can see right now the green number on the right. That's the current price right now. So you can move the mouse out of the way, and then you see it's displaying the green number.
Yep.
That's what it is right now. That green number. So yeah, $576,469 a share. So it's the same company, but this is like a class of Berkshire stock that he just never split as an experiment of what would happen if you never split a stock.
But it right now, is it A or B?
The B is the real one. You can see it's the same chart, but this has been split from when it was originally IPO'd. It would be, well, what was it's 380 now. What was the B? It was 576.
It was, you mean the A?
Yeah, the A.
It was like 500,000 something. Oh, okay.
A is divided by 380. So 576,211 divided by 380 means that over the course of many splits, this is 1,500 times. That means that there's 1,500 times more shares of BRKB. Does that make sense?
Yeah.
This would be like the equivalent. The B class would be like if you split that 1,500 to 1. So if you split this and made it the same as the B, you'd give every person that holds one share of this, you'd give them 1,500 shares.
Okay.
So it's same thing, but just this is without splitting. Let's look at one of my favorites actually for long-term holding. Let's look at Costco, COST. In fact, you can even add Costco to your watch list because Costco is awesome. Now let's go to the weekly chart. Go to the 1 hour and let's switch that to weekly. Yep. No, not there. You got to hit the 1H. Close that menu.
Mm-hmm.
And it's the 1H next to the gear, not the gear.
There we go.
Yep. Right. And let's go to weekly max.
What is all this at the bottom here?
Those are earnings announcements. We can tell it not to display those because it's kind of distracting at this time frame. But those are every dollar sign there, that's a dividend payout.
Dang.
But
what is it? I had a little bit of trouble in
2020.
2022.
But look at Costco back since from like 2000 to 2024. Like shrink the bottom. Like if you go to the x-axis on the very bottom and then you start pulling it to the right, it should shrink the whole chart. Like down where it says like 19, 20, 21, etc.
Mm-hmm.
Yeah, just click in that area where we have the year number.
Yep.
Like, and just pull that other way. Keep going further.
Yeah, I don't have a map. This is a laptop.
No, it's okay.
This is a laptop. The touch screen doesn't like doing it.
No, you don't need to. You don't need to use the touch screen. Just use the mouse.
The mouse is so weird. It's like you have to use 2 fingers in order to left click.
Oh, we can look over and see.
Is it dragging to the right? This is what you wanted?
No, I wanted to go small. I want you to compress it more. You're like expanding it. Yeah, keep going that way. You want me to do it on my screen?
I think I can figure it out. It's which way, left or right?
Should be right. Is that making it? That's making it no other way though. All right, I tell you what. Actually, let's add another time frame. So weekly. Let's add a new time frame. Go up to the weekly thing.
Gotcha.
This will just be easier. Customize list. At the bottom. Add time frame. We're going to add a new one. Intraday. All right. Time interval, max available. Oh, no, I'm sorry, not intraday, daily. My bad. We're going to go to max available, and then aggregation period, we're going to set to month. Okay. All right, now let's look at a monthly chart. Max M, yeah. Now let's look at it from like 2000 to the present. Where was it? What was the open? See up at the top, by the way, it'll say like, you'll have numbers there that'll say, O, like, yeah, you can stop there. It'll say OHLC, open, high, low, close. So we can see that it opened like wherever that was. That was, yeah, 1/1. So January 1st of 2000, $6. Now it's just shy of 700. Yep. This is called compound interest. This is why Costco is an epic stock.
I don't even know how they make so much money. I think it's the membership thing.
Yeah. We can look at the same sort of chart with Apple, AAPL.
When did the iPhone get released?
2006.
So it still didn't. It didn't shoot up as much until.
Yeah, but it was the equivalent of about $2 a share.
Now it's worth.
It's split many. The reason it shows it reflects as $2 a share is because Apple's been split many times since then.
Is there a way to see if Apple hadn't been split? How much the shares would be worth?
I don't think so, but we can look at it as a log chart. So go to settings. Yep. And go to price axis and use log scale. Over down on the display, it says use log scale. And then hit OK. So now it's logarithmic. So you can see it goes from like 10 cents to 30 cents to $1 to $3 to $10 to $30 to $100 to almost $300. So that's a logarithmic scale. That's what it would look like if we were looking at it as a logarithmic instead of exponential. Pretty cool.
That is a lot. Should I turn this off?
All of these, yeah, turn off log scale. That's kind of confusing for most other stuff. But you can see that it is kind of price axis, yeah. That, you know, I'm fully, while our primary focus here is making, you know, high returns relatively quickly, I am fully someone who absolutely supports accumulating stock like this because, you know, with Apple here, it's going to continue going up for the foreseeable future. And if you acquired $10,000 of it and it's gone up, you know, 100x, that would be $1 million of gains over 15 years.
Yeah.
Then do that with across, have.
I think I heard someone tell me that if you want to hold on to long-term stocks, buy stocks in companies that you use and have faith in, because
I
if
don't.
something's going wrong, like you're an Apple user, if Apple were to put out like a terrible phone or some sort of leadership problem happened where it was going in a bad direction and you as the end user were able to experience that, things aren't getting better, things are getting worse, and then
Yeah,
you look at your stocks that it's going down.
that might be true to some very limited extent, but like I'm generally more going to be focused on what is just really, really solid. Like Apple is solid. If you look at like the S&P, again, go back to the Market Watch thing, and we go to indices, S&P 500. We can see that Apple is a very, very solid component of that. They're not going anywhere. NVIDIA is solid. Google is solid. Microsoft is solid. Amazon is solid. Costco is solid. Like these are all companies that are not going anywhere. Home Depot is fantastic.
Where's that?
HD next to Amazon, consumer discretionary.
Oh, there it is. Yeah.
Home Depot's that's a super solid company. That's not going anywhere. Like I think a lot of it is just common sense.
Yeah.
But let's talk about options. Because this is where you're really going to be actually making some money. So, let's look at. Let's look at SPX. And let's talk about
Which one were we using? This one?
yeah. No, I'm sorry, 1 hour. We also need to add something to that we'll go into a little later. Yep. Go to studies.
Do we need to turn the thing on so that we don't have the aftermarket watch?
No, that's fine.
Okay.
For now. Go to studies up at the top right-ish area. Edit studies. And search in that search bar HILO, HILO. All right. And then click on that and add selected. Then hit the gear at the top right. All right. Very good. And now we're going to want to, let's change the, we don't need to mess with anything else. Just change the length to 21.
All right.
And okay. This is the only thing we're going to need.
All right.
So that is basically a tool that assists with entry and exit decisions. But now we're going to kind of move away from this and talk about options for a little bit.
All right.
So let's go to trade tab, or control 2. Let's go to Jan 26. And then for strikes, type in like 50, 40. 40 is probably fine. All right. Now this may look intimidating at first. I assure you it's not. It's like it's a fuzzy teddy bear. let's talk about option pricing. So first, what is an option? So we're going to have two types. In fact, we can pause Thinkorswim. I'm going to share the whiteboard again.
Gotcha. That'd be good.
Let me stream whiteboard. Oh, did I lose all of our slides from before? Maybe I did. Oh well. All right.
Maybe if you hit Control Z, they'll pop back up.
Nah, I think they're gone. That's fine. All right. There's two types of options fundamentally. We have calls, puts. Oh, shit. All right. We have calls and puts. Calls, and both calls and puts can be either bought or sold. We can buy, we can buy, or we can sell, or we can short sell, sort of. Both calls and puts. So a call is, come on, the right but not the obligation to buy an asset at a specific price at a future date. A put I'll just copy and paste this actually, because I'm lazy. A put is the right but not the obligation to sell an asset at a specific price on a future date. I think on would be more correct. So what does that look like, practically speaking? So let's say that you have, I don't know, you have a house. And there's a chimney. Yay. All right. And this is you. Meh. All right. I go to you and I say, let's say that your house is for sale. What would you want to sell? For this example, what would you want to sell the house for?
Just say 200 grand.
Okay. All right. So your house, you're saying it is for sale for 200,000. And I go to you and I say, hey, I'd like to buy an option on your house. I want to pay you, let's say, $5,000 for the option. So we have this contract. Important word. And I now have the right. I have the right to buy your house for 200,000. And let's say that this contract is a 1-year contract. So that means that anytime in the next year, I have the right to buy your house from you for $200,000. I can go to you any day and say, hey, I want to buy your house now. And it's at a predetermined price, that being $200,000. Okay?
Yep.
And if I exercise my right, you are obligated to sell me this house. So for you, this is an obligation. For me, it's a right. But I'm also paying you $5,000. You get to keep the $5,000. So how this would work in a market sense would be if the house is only worth $200,000 and a year goes by and it's still worth $200,000. Well, it wouldn't really at that point make any sense for me to buy the house because the price hasn't changed unless I decide I want it at that price. And if housing prices go down, you get to keep the $5,000 because you having sold me this right. If the house goes down in value, then why would it make sense for me to exercise a right that I paid $5,000 to have? If let's say that the house is now worth $180. All right, if the house is now worth $180 and I paid you $5,000 and I have the right to buy it at $200, but now it's worth $180, well, that doesn't make any sense, right?
Right.
So you would keep the house and you would pocket the $5,000 upon the expiration of this contract.
Okay.
On the other hand, if let's say the housing market just continues to go absolutely insane, and let's say it's now worth $240,000, housing's gone way up. Well, now, if the house is worth $240, and I still own this contract, I have the right to buy this house for $5,000. And we're assessing the market. And now I think, okay, this house is worth $240. I can go to you anytime before this contract expires, and I can say, hey, Jean-Luc, I want to exercise my right and buy the house for $200, even though it's worth $240 now. Are you following?
Yeah.
Okay.
So I understand how that option works. Now, that's if you're expecting that the asset is going to increase in value.
Yes.
A put is what you're going to use if I don't understand how the put would work. This makes sense to me.
Okay.
The
I'll just do a simple, and I'll make a note up here that this is basically a call. Now, there's always going to be two parties with a call option. There's the seller of the call, and to the seller, the call is an obligation. To the buyer, the call is a right.
Yeah, it's an obligation for the seller, a right for the buyer.
Yep. Now, on the put side, since it would make it kind of weird to do it with a real estate example, I'll just use like a market example.
Okay.
So we'll just say here that we have the put seller, put buyer, and we have and I'll do the same thing I did before. I'll do like let me just do it like this. 20, 19, 18, 17, 16, 15, 14, 14, 13. Okay. So if we have like a stock, and let's say that this stock is trading at $16 a share.
Okay.
All right. It's at 16. And let's say that you want to sell a put and I want to buy a put. And let's say that we do it as like a protection thing. So it's, we go to 15. So we do a transaction where I buy this put at the 15 strike. You sell the put to me at the 15 strike. And let's just say, for example's sake, that this put option is these are such small numbers. Let's say that it's $3 or $2. Okay. Let's say that this option is $2 and it's at the 15 strike. This is our contract. The way this would work is that we have the stock here, and I've bought it, this contract, for $2 from you. And what that means,
I think Megan's home. I have to. She can't open the deadbolt, so I'm gonna have to open it.
yeah, you're good.
And
You good?
Yep.
Okay. So let's say the stock's trading here at 16. And let's even say, for example, that I already own some of the stock.
Okay.
Let's say I own some of the stock and I want the stock to go up.
Okay.
And if it goes up from 16, let's say I bought it at 16, I'm going to make money if it goes up. Okay.
Mm-hmm.
But I'm worried about it going down. I don't want it to go down. Because at like $12 a share, if we hit this level, then I would be down like 33% on this. You got that? Following?
Not exactly. So
If the stock is 16 and it goes down $4, that's, no, sorry, where's my brain? 25%. 25%.
okay. So
like, let's say that I'm scared it might go down to here.
okay.
That would be 25% decline. I'm scared of that. So I buy a put at $15. And in this case, I am paying you a premium of $2. That's this. That's premium. So I am paying a debit of $2 and you're receiving a credit of $2. And this has a specific expiration date. Let's just say that that is, 1 month. So the way this would work is, like, the benefit for each side here is, if the stock goes up, okay,
Mm-hmm.
if it goes up, then you simply pocket this premium. You get to keep that.
All right.
And that's like what's in it for you. I lose the $2. Okay.
Mm-hmm.
But if the stock goes down, let's say it goes down to, let's say $12. Well, I, as a buyer of a put, I have the right to sell my stock at 15.
But if the stock's
You have the obligation to buy it from me at 15. You have the obligation to pay me $15 a share for it, even though it's only 12 now.
okay, so this is for shares that somebody owns. This isn't like a borrowing situation.
I mean, we'll get into writing spreads and all that. It gets a little more complicated than this. This is a very simple example, but in this case, like, if I'm paying $2 for this, anything below 14, this put is now benefiting me more than it cost me.
Okay.
Does that make
So
sense?
yeah, so if the price drops, you're going to make a profit because they have to sell to you at the value that you bought the put at.
Well, no, they have to buy it from me. So in this case, if the stock is down here, it goes down to 12,
Mhm.
and I'm this contract is still open, and we're within this month. That's also important. We're still within that month before this contract expires. I can go to you and say, hey, the stock is down. The stock is at 12 right here.
Yep.
I want to sell it to you at 15. And because of this contract, because you sold me the put, you would be obligated to buy these shares from me. I can now sell them to you. You're obligated to buy them from me for 15, even though the stock is lower than 15.
Okay. So you're handing them money and they're letting you borrow the stock, and he's thinking that the stock is going to increase in price, and
Yes, stay
that
where
means
it
that
is or increase.
he's gonna pocket $2 for the right to buy it at 15. But if the market drops, then he has to buy his shares back at the price that we bought the put at. So now we're going to make the profit off of the stock being worth
Yeah.
the same amount that we borrowed it
Well,
for.
for me as the buyer, like if I own this stock, for example, this benefits me because now, even though I bought it at 16, because I have a put at 15, my risk on this stock is $1 plus the cost of the put.
So $3.
Yeah. So if it goes down by, $4, then it's limiting my risk. It's basically making it so that no matter what happens, so the stock could go to 0, and the most I'd be down on this transaction is $3 per share.
Okay.
Does that
So
make sense?
you won't be losing the whole value of the stock, but you will be losing something.
Right. So the like a better example would be, let's say that it goes to 0. Like, I'll make that up as a 0. All right, stock goes down to 0 basically, or 1.
Mhm.
If it's at $1 a share, let me get rid of that. This is a mess. Okay. 1. All right, stocks went to $1 a share
Okay.
within this month. I can still go to you and say, hey, I want to sell my stock to you, and you have to pay me 15 a share for it, even though it's only worth 1.
Okay.
Does that make sense?
Yes.
Okay.
and then all the rest of the money goes directly back to your account.
Yeah, exactly. I would be able to sell this for way more than it's worth. So it's a way of managing my risk in a way.
I see that you're putting like bumper or training wheels on
Yeah,
your trade
it's limiting it. Yeah, exactly. So let's
because
do
you have a wider mark to hit for winning.
yeah. So let's do also a call. Let's do call buyer, call seller. All right. Let's do the same deal. Let's just move it down a little bit to give me some extra room to write. All right. If the stock, the underlying stock is trading at, let's say, $15 a share.
Yeah.
So it's right here. And I think it's going to go up. That's where I want it to go. But person on the other side, they think it's going to stay where it is or go down. And so, like, let's say that I go and I pay I go and pay, just a moment. Let me mute the thing. One second. Let me take this. Okay, I'm back here. All right. Let's look at the, you still there?
Yep.
All right. Let's look at the example of a call where let's say that, let's say I buy it even at, 15 or 16. We'll do 16. It's a good number. All right. So 16. And I do this for, call. It doesn't really matter. The price isn't super relevant here, but we'll say this is we bought it at the 16 strike. Okay.
And it's trading for 15 right now.
Yeah. So I have the right to buy stock at 16.
And you're going to pay him a nominal fee.
Yeah, and then I'm gonna pay you some amount of premium. And this is the obligation to sell at 16. So I'm going to pay you for that right. So if this stays where it's at or goes down, then this person keeps the premium. All right.
Gotcha.
They keep that premium. It's like, think of it like an insurance premium. It's really kind of the same thing. Like, you pay the insurer a monthly premium or a 6-month premium. That's the contract length. Mm-hmm. And anytime during that contract, if you get into a car accident, then you have the right to call up your insurer and say, hey, we have this insurance contract, so now you're obligated to buy me a new car. That would be more like a put, I would say, but this example works just fine.
Gotcha.
So now if this goes up, let's say it goes up to $20 a share. Well, now I can go to you and I can call that stock and say, hey, I want to buy it from you at 16. And then you'd have to pay me or you'd have to give me the stock at 16, and then I would instantly be up on that position by this amount.
And then do you have to
$4
sell it?
minus the cost of the premium.
You have to find another buyer for the stock that you just got at a lower price, though, right?
Well,
So you get
if I got it at 16 and now the market's, it's trading at 20, like I could sell it right away at 20. I could also, if it goes up, I can also just sell the call itself without ever exercising it. That's another thing. So, now it's up here. It's what's called, we got 1, 2, 3. So we're now, from where I got it at 16, it's now $4 in the money. That's an important term. ITM, or in the money. That means that the price of the underlying asset is now higher than the strike price of the call, or lower than the strike price of a put. Like here, previous example of our put at 15. If this asset goes below 15, then this put would be what we say in the money.
And it's higher than the strike price that we bought it at.
Yeah. And now in the case of a call, it would be, the market would have to go up, which 16 would have to be lower than the price of the underlying asset. So if the stock goes to 20, 16 would be well in the money.
Yep.
And then on the other side, we just call that, I'll put this up here as well. On the flip side, OTM, out of the money. That's pretty obvious what that means. That just means, if we buy a call at 16 and then the stock, let's say it goes down to 13 or even stays at 15, our calls up here would be out of the money. Okay.
Yep.
Everything all good? Any questions so far?
No. I understand that. So, not selling a call without exercising it. So, because things are worth $20 now, and we bought it,
we don't
right,
have to so exercising would mean that we convert this call into stock.
But we can just sell the contract to somebody else who
Yes.
wants to buy it at 16.
Yes, correct. Now that it's in the money, the contract, let's say that we paid, let's say we paid $2 for it at 16, and now it's worth $6. That, like, the contract itself as a completely separate security would have appreciated. So we don't have to exercise the call, which means converting it into stock and then sell the stock. We can just sell the call directly.
Okay. And you want to sell the call for less than the total amount of the stock. So as long as
this is a very simple example, and we'll go into some other examples. We could also say, like let's say this option here that we created was, for your house, that example, and say I paid you $5,000 with 1 year. Well, if we had time decay, let's say that it's 6 months or 4 months. Okay, let's say 4 months. So it's now 4 months has gone by. It's now 8 months from this contract expiring. Okay. And I say, okay, I want to sell this contract to someone else, but there's less time for the house to go up or down in price, right?
Yep.
Only 8 months now. So if someone else is going to buy this call, what do you think they'd want to pay for it? Maybe
a third less.
That, yeah, I'd say probably so. About, say 30. Say we take it and now we sell it to someone else. I move to front order, bring Order, bring to front. Okay. Never mind. All right. Let's say that we sell it to someone else. So now I'm out of it. I've lost
2,500 or 1,500.
yeah, I've lost 1,500. Someone else has bought it. And now let's go to 4 months before the contract expires. Well, now it's dramatically less likely that someone's going to do this. So maybe that person would pay 500 for the same contract. And then it expires. When it expires, if the house hasn't appreciated, this contract is worthless.
Gotcha. So options are worth less the more time has decayed.
Exactly. Let me pull up a chart of option. It's called theta. Let me share a different tab. Let's just find a good. This one is beautiful here. So you see 90 to 60 days before an option expires, it loses this much. In the next 30 days, it loses like 3 times more. And then the next 30 days after that, up to expiration, it loses like 5 times more than the previous 30 days. And probably 10 times more than 30 days before that. It's an exponential curve to 0.
Okay.
So let's go to this is one of the option what we call the Greeks. There's theta, vega, delta, gamma, and rho, which we don't need to get into all those today because it gets a little dense, and we're mostly just gonna, like, in the real world, we're mostly going to be looking at theta and delta. Those are the 2 most important ones.
Gotcha.
Gamma and rho, I personally never really used. Sorry?
Yeah, so you said that you use theta and delta decay more than gamma or what?
Then gamma, vega, and rho, RHO.
Gotcha.
So we can go. What time do you have to kind of wind down?
I think as soon as options are done being discussed, I should probably.
Well, I could keep going for another 6 hours on just options, and that's not an exaggeration.
Gotcha. Do you think that this is a good wrap-up point?
Yeah. So tomorrow or whenever your next day off is, we can go into the Greeks, and we can go into especially delta, and then we can also learn how to use the options chain on Thinkorswim.
Gotcha. I have. Let me see my calendar. Tomorrow I work. Though I would probably the evening might be open. Actually, probably not. A call could come out at any time. This weekend I'm off.
Yeah, let's do your next session where you have 48 off. Let's do those days.
Okay, so that's this weekend.
So Saturday, Sunday, is that your next days off?
Yes.
All right, cool. All right, sounds good.
All right.
I hope that this has been an informative day. I'm going to put all this on the whole day on YouTube, so you can rewatch it if you want to, when you're on duty or whatever, just to kind of get a review, a recap. And yeah, I've thoroughly enjoyed it.
I've enjoyed it as well. Thank you. It's been very informative, and I feel like I've learned a lot.
All righty, good deal.
I'll see you later.
See you later. Bye.